Okay, so you're most welcome to today's class. This is Samuel Ibanda. We are here for financial accounting revision class, okay? So basically what we want to just look at today is this one topic called inventory, okay? This topic called inventory. If you were to look at our syllabus very well, inventory is one of those topics that we need to, by the time we get to the exam, we need to know, okay? And one of the other things that we also know is that inventory is one of those, it's a key component of working capital, okay? Inventory is a key component of working capital. So it's very good that we understand what it exactly entails. Now, from the examination perspective, the examiners often found ways of how to examine your understanding of inventory, okay? And this is so much to do with either defining inventory, either items of how to treat inventory, and maybe things like carriage costs, how to measure inventory, okay? What is net realizable value and so on, okay? So, and then what is the maybe also impact of inventory on profit and assets. And then we also have different valuation methods for inventory, like FIFO, ACCA, and so on, okay? So today we just want to do a little summarize through what you basically need to know, okay? Yeah, so we have, yeah, as you can see, this is my screen, and I'm a person who always emphasizes that as somebody who's preparing for the exam, just make sure at least whatever you have on the course outline, at least or syllabus, at least you have knowledge on each of those items, okay? Yeah. So as you can see, I just see this. I don't know when a question on inventory was set. One of the reasons why inventory is a very good number is because once it comes, doesn't really have a lot of complications in it, okay? Once it comes, you can be able to, yeah, get some substantial marks. At least that is everything that we are trying to do here, okay? Yeah, it's what we are trying to make sure that we do. So I shared with you some notes, okay? I shared with you some notes. I know some of you might have studied this because this is a revision class, okay? So I want to assume that you have studied this, or you've even tried out some questions. So I would also welcome any questions that if you may have, okay? Yeah, but just to show you a little, these okay. So there are those notes that I shared with you, the ACCA notes. They actually have inventory as a topic, okay, on its own. So that can help us, give us some guidance, just in case for my people who are freshers. So I'll just try to run through a little, and then we can be able to proceed, okay? Yeah. Sorry, my screen is struggling. So I guess you, most of you received these notes, okay? Like I said, they have very a good write-up on some of the topics, especially ones that you're preparing for, okay? So I just want to use the same just to show you something small here. Still inventory, let me just try to check a little. So when you hear the word inventory, definitely, of course, some other literatures may call it stock, but as you progress, the word stock itself actually refers to what? Refers to shares, okay? So you want to make sure at least you're using the right words, that is inventory. Okay, I think it's right here. So this is inventory. Now, inventory is governed by the standard IAS 2, okay? It's IAS 2 that gives us the guidance on recognition, measurement, okay? And disclosure of inventory, okay? Yeah. So like I said, of course, inventory is a very important component of the business. And as you can see, inventory affects our profit when we are determining our gross profit, but also inventory also goes to the balance sheet, which is your statement of financial position under your current assets, okay? So you know that inventory is governed by IAS 2, which gives us the guidelines for valuation, presentation, and so on. Now, one of the things that you may need to understand, especially when it comes to inventory, okay? Of course, here they're just giving us, they're telling us we may have to calculate closing inventory or cost of sales. Now, some cases, sometimes the examiner gives you additional information on inventory, okay? Instead of giving you the value of inventory, they would rather give you additional information on inventory. And all they want you to do is to be able to determine the value of inventory that you're going to use within your calculations, okay? So, and what the examiner wants there is to test your understanding of inventory, okay? By that I mean you need to know how inventory is valued, okay? So I'm going to show you one of the examples where the examiner may want to test that, okay? But for now, we can try to proceed. So inventory is also a component of cost of goods sold. I think we now know what cost of goods sold is, okay? As you can see, both opening and closing inventory are part of the goods the cost of goods sold, okay? And we know why that happens. So I don't want to dwell so much on that because at least I know you know how to calculate the cost of goods sold, okay? You at least know that every time we are calculating cost of goods sold, which is your cost of sales as well, it is your opening inventory, add purchases, okay? And if it's, for example, it's a manufacturing company, we call it cost of production. And we know that the cost of production comes from what? From our manufacturing account statement, okay? And our manufacturing account statement where we look at the prime costs, the factory cost, and so on, okay? And then look at also changes in work in progress, like that. And then less your closing inventory, and then you're able to get this, okay? So it's good for you to know this. Then you also know these carriage inwards and carriage outwards, meaning that this is like transport or logistics costs that involved. If it's carriage inwards, these are commodities entering the organization, and carriage outwards, here we are trying to look at what we spend in delivering inventory to our customers, okay? And we know that carriage inwards is actually added onto our purchases, okay? And for carriage outwards, this is recognized as an expense, okay? Yeah, so The reason why they bring in carriage inwards and carriage outwards, as you can see from even our syllabus, the examiner expects you to actually also have a greater understanding of how the carriage inwards and the carriage outwards also works. Okay, so it's not by mistake that you see such coming in. And of course, at the end of the day, these work hand in hand. Okay, they work hand in hand because ideally to bring inventory into your premises, you definitely need carriage. And that's why you see here, they're asking you for the accounting quick treatment of carriage costs and inventory. And the carriage costs, those are your carriage inwards and carriage outwards. Okay, yeah. So that's what I just wanted to stress. So just right here, they just give us some examples. You can go through these after the class. They are very friendly for you and much easier. Okay. Now, one of the things that I want to highlight so much here is this point, because I know this could be a technical point for you. Now, you could have cases where there's some part of the inventory that is written off. Okay. And why do we write off some inventory? We may write off some inventory maybe because it was lost or stolen, or it was damaged maybe through fire and it becomes worthless. And then it can also become obsolete. Okay, by obsolete we mean out of fashion, or it's basically if you have, for example, inventory of desktops, those are big desktops we used to have for computers that were like TVs. Okay, those could now be obsolete because at least you get everywhere and you're seeing flat screen. So those are like obsolete. Okay, so ours is to understand if at all these goods are obsolete or are stolen or are damaged. How do we basically account this within our books? Now, one of the things that the examiner will do will give you some inventory, maybe within your trial balance, and in the additional information they will come and give you maybe a comment and say maybe part of the inventory became obsolete before the year end, and therefore it was written off. Okay, so that is something that you need to basically do. For example, there is an example here. They are telling us if the goods originally costing $500 are now obsolete and can only be sold for $150. Okay, they are asking you, so what would you exactly do? Now, as you can see, of course, here definitely would have a loss of 350. And this loss of 350, basically, your double entry is you're going to, of course, you're going to credit. Now, of course, you're crediting your inventory and debiting your P&L. Now, every time you hear somebody saying we are debiting our P&L, it means we are expensing this through P&L. So you are adjusting your inventory, okay, and then taking this amount within your P&L. So if the examiner has given you, for example, inventory of, let's say, 2 million, and says that maybe part of the inventory of value 1 million, part of the value of inventory of 1 million become obsolete and will be sold for, let's say, maybe 300,000, then you have to make the adjustment. Okay, and we are saying the loss should go to the P&L. Okay, as an expense. The same thing also when it comes to if inventory is lost through fire. Okay, for example, if maybe before the year end, one of our stores got burnt. Okay, now if we have no insurance, now of course some companies may have insurance. Now, if we don't have insurance for such inventory, okay, we have to directly expense that inventory, okay, to our P&L and include it under our expenses. So as we adjust our inventory to make sure we're having the right value, that other value that we've adjusted of our inventory is debited to our P&L under expenses. Now, there are also cases where inventory is actually insured. Okay, now I want you to listen very well to this one. Now, if inventory is insured and it gets burnt, the first thing that we need to do as a business is to submit an insurance claim. Okay, is to submit an insurance claim. And once we have submitted an insurance claim and it has been confirmed that actually inventory, they will be able to pay back what we lost, then it means that when we are adjusting our inventory, we shall of course credit inventory, because inventory is an asset which is reducing, and then we shall now debit what we call the insurance receivable. Now, we only debit insurance receivable when we are sure that the claim has been accepted by the insurance company. This is very important. Sometimes people just immediately, because inventory has done what? Inventory has gotten burnt. Directly, people want to move this amount of money to the insurance receivable. Now, remember, when it comes to the recognition of the asset, okay? Remember what we said about the definition of the asset. At that point in time, that the insurance receivable has not yet come into play, because you're not yet sure that the insurance company will actually accept this, okay? So it's very good for you to read through and understand what is the scenario at hand, okay? So for you to recognize insurance receivable, they should have accepted. So you should have at least an expectation of economic benefits flowing to the entity, okay? As a result of something that has happened in the past, fulfilling the definition of what an asset is, okay? So that's very important that I wanted to comment on this. So the examiner can bring something to just trick you around that area. And some of this information, by the way, as you read it through, like some of you were asking, could you maybe share some of the objectives that can come? Some of this information can actually come in just a single objective, okay? And they're asking you, especially around the understanding of inventory. And like I said, every mark matters in the exam, okay? Because one mark can actually pick you from 49 to a 50 and will secure you instead of going back for this paper, okay? So that's very important for us to understand, okay? So we have a case here now. Like the way I told you, the examiner will bring something like this, maybe within the additional information, okay? And you have to do something on inventory, and then also make sure that if maybe there's a company that is written down that needs to go to, let's say, to the P&L, you have to reflect that, okay? So let's just read through here. They're saying Lucas Wager is trading as Fairlock Fashions. He ends his financial year on 31st March. So they are saying on 1st April 2015, okay, I'll use 2015, he had goods of inventory valued at what? At this value, okay? So this is like the beginning. This is your opening inventory. And right now, I believe you now understand that opening inventory is, of course, the one that was closed in the previous period. But when you're preparing your financial statements, opening inventory is only used when we are determining the cost of sales, okay? The rest to do with what we use else in the statement of financial position is the closing inventory, okay? Yeah. So they're telling us that during the year to 31st March 2016, he purchased goods costing how much? Costing 48. So these were his purchases, okay? And they're telling us that fashion goods, which cost 2,100, were still held up in inventory as at 31st March 2016, okay? And Lucas Swag believes that these could only be sold at a price of how much? A price of 400, okay? And they are going on to say that the goods still held in inventory at 31st March, including the fashion goods, had an original purchase cost of how much? Of 7,600. They go ahead to give us also the value of our sales. Now, this question is a bit, it's comprehensive, that it is bringing even gross profit and also bring in, because they want us to determine the gross profit. So all you have to do is to understand, how do I make adjustments on inventory based on this scenario at hand, okay? That it's very good that you understand that. Now, all this is actually around the valuation of inventory, okay? Now, you cannot proceed so much with this if you don't understand what IAS 2 says about valuation of inventory. Okay. So one of the things that you also need to understand when it comes to here is the aspect of how to use all this information that they have provided. Okay, like for example, they are telling us right here that he had inventory. This was his opening inventory, so we know where to use this opening inventory. Okay, and then we also know the purchases which they have given us. So the dynamics that we now need to play with are on this inventory, okay, which this guy thinks would actually be sold for what? They are saying inventory, fashion goods which cost 2,100 were still held up in inventory at 31st March 2016. Lucas believes that this could only be sold for a sales price of 400. So it means that we are actually going to lose some part of this value from 2,100 to 400. Already this is already a big loss. Okay, so based on that, we are going to now see how to value our inventory. Now, one of the things that you need to know, and you can note this, like I said, this is IAS 2, okay? And IAS 2, the standard says that we should value inventory at the lower of cost and the net realizable value, okay? Inventory should be valued at the lower of cost and the net realizable value, okay? Now, yours is to ask yourself, which one is the cost and which one is the net realizable value, okay? So as we can see here, we see that our net realizable value is what? Is actually 400, and this is our cost. So the standard is saying that we should value inventory at the lower of cost and net realizable value, okay? So that's the principle that we are going to basically use here. And then they also went ahead to say that the goods still held in inventory at 31st March 2016, including fashion goods, had an original purchase cost of 7,600. So including these fashion goods that they have told us. So basically, they're giving us our closing stock that we have to make sure that we adjust, okay? So right here, we already have the solution within this. Maybe I could just do a little guide you, but these are the goods. So basically, and you know, when we are trying to look at valuation of inventory, in most cases, we are valuing the closing inventory, okay? So in this case, as you can see, our closing inventory was 7,600, but like they told us, part of this includes 2,100 that can no longer be sold at this value, but will now be sold at what value? At the 400, okay? So this is the kind of adjustment that is actually being made here. This inventory is part of the 7,600. So this inventory of 2,100 can only be sold at 400. Like you've seen, we are looking at cost and realizable value, okay? And like what they told us, that inventory should be valued at the lower of cost and net realizable value. So this is what we have when it comes to this kind of inventory. Now, the other component of this inventory, the 5,500, for it remains the same, okay? So when you, of course, when you get the realizable value of the 2,100, you get your 400, and then get the 5,500. At the end of the day, you're going to see that we are going to have now a comparison between the 7,600 and the 5,900. So when you come to your calculation here, you're going to see that what we are going to use as our closing inventory is actually 5,900. And you can use another way to demonstrate this, okay? But the whole ideal thing is that the difference between this 2,100 and the 400 needs to be written off, okay? So the difference, which is I think it's 1,700, needs to be written off. It doesn't need to be part of our inventory cost. Okay, so that is why it has been put here as a written down value. And once we are calculating our inventory, we shall use our sales figure as it has been given. Okay, opening inventory will remain the same, just as we have been given to us. The purchases are also the same. Okay, just as given to us. All that we are only valuing is the closing inventory, and in most cases that is the case that you'll find in the exam. Okay, and we're able to get our respective, these are like goods available for sale. Okay, and then able to remove your closing inventory, which has now been already written off down. Okay, by that perspective. And then finally, ours is to of course get the cost of goods sold, and then we have this. Now the 1,700, this 1,700 will be included within your expenses. Okay, and that's why we are not having it right here, because here the question here only asked us to calculate our gross profit. Okay, so we've not brought it, but when we came to our expenses, we'll definitely include it right there. Okay, so I just wanted to give you that brief on that part before I move down to our key element for the day, which is the valuation of inventory. Okay, yeah. Okay, so this you can find and read, like you seeing their friendly notes that you can utilize and see how everything is done. This is about counting of inventory, just giving you how inventory is counted and so on. But my interest is so much here on valuation of inventory. Okay, valuation of inventory. So the standard rule is this: inventory should be valued at the law of cost and the net realizable value for each separate item or group of items. Okay, and we have two methods that we usually use, which is FIFO and ACCA. We also have another one, which is LIFO, last in, first out, but LIFO has been criticized, of course, even from its perspective. LIFO, last in, first out, like you cannot bring in something as last and it gets out first. Okay, because already you have some goods in. So in most cases, we are using FIFO and ACCA. And even when you're preparing for the exam, in most cases, these are the two concepts that the examiner would really want to examine you on. Okay, yeah. So now we also want to understand, especially when it comes to valuation of cost inventory, like we've seen, especially maybe in our places or even for other businesses that we've had, inventory sometimes can be valued at the selling price, maybe because somebody is going to sell this inventory, maybe if it's a vehicle, maybe they're going to sell it 200 million, they may value it at that value. Okay, but ideally, of course, ours as accountants, we know that that is wrong. We cannot value inventory at the sales value. And the reason why we cannot easily value inventory at the sales value is because we've not yet sold the inventory. Okay, so we don't want to overstate our inventory. Okay, yeah. And then of course, we can of course value inventory at the expected selling price, less costs to be incurred in getting them ready for sale and then selling them. Okay, and this term is what we are regarding to as the NRV, which is the net realizable value, which the standard speaks about here. If somebody is asking you to determine the net realizable value, it is basically the expected selling price of that inventory, less costs that will be incurred to get that inventory ready and to sell it. Okay, that gives you the net realizable value. Okay, so when somebody says inventory is valued at the lower of cost and net realizable value, you should at least understand what net realizable value actually means. Okay, so that is the principle, and that's what the standard basically says. Okay, now inventory can also be valued at their cost, at the historical cost, the cost at which we originally bought. Okay, but for matters of the standard inventory valuation, we usually compare with these two things: the inventory net realizable value and then the inventory's cost. Okay, yeah. So that is about inventory. You can try to look at this, and you'll be able to understand more. Okay. So I have I have a case here. Okay. And I actually want to comment about this. Okay. So we have a case here where they're telling us that the following figures relate to inventory that was held at the year end. Okay. So we have cost, we have the selling price, then we have the modification cost enable to sell, we have the marketing cost, then we also have the units, okay, held. The same thing with here, with here. Now, here the examiner wants to test your understanding of cost and net realizable value, okay, and also understanding the principle that we value inventory at the lower, okay. So we are going to look at how A is. Now, A, our cost is 20, okay, and our selling price is 30. Remember, they told us about our net realizable value. They told us that net realizable value is the expected selling price, which is 30, okay? And they have told us that we should less any costs that gets this inventory to be sold, okay? Which in this case they have given us a 0, and then it goes ahead to ask us to remove any selling cost, okay? Which selling costs we are seeing as to be a 7, okay? So when you come right here, what you have when it comes to inventory, A, the cost is what? Is 20, okay? The net realizable value definitely will be 30 minus 0 minus 7, which is 23, okay? Now, we value inventory at 20. Remember, we are saying we value inventory at the lower of what? At the lower of cost and net realizable value. And that's why we value the unit price at 20. And this 20 will be multiplied by the number of units, which still remain the same to come to this amount, okay? So that is also where the examiner is also testing your understanding of cost and NRV. The same thing also happens for B here. So B, the cost is what? Is 9. The modification, okay, the cost is 9. The selling price is 12, okay? Now, the modification to sell is actually 2. When you get 12 minus 2, you actually get 10. The marketing cost is again 2. When you again subtract there, you actually get 8, okay? So for B, we have 9, and then we have 8. So we take the lower, which is 8. So that is why you see the valuation of B will actually be 8, okay? The same thing will also happen for C. The same principle, okay? And you're able to get the value of inventory. So the examiner sometimes wants to trick you, may bring you a question and say inventory is valued at this value, and they want you to test your understanding of this principle, okay? So just in case the examiner wants to test you in that direction, you should really have a good understanding of how to really manage that, okay? Like I said, it may not be a question, a full question like the way, okay, like what we are seeing right there, but the examiner can use the additional information, okay? Especially when it comes to the preparation of what? The preparation of financial statements. The examiner may want to tweak it from that perspective. Or they can also set, they can set a full number on inventory, okay? They can set a full number of inventory. Let me just show you something that was set in March 2021. So this is a question that was set in March 21. As you can see, I think this is the last exam that we did, okay? So this is Kilungi, and they are telling us that Kilungi provided the following information for the year ended. So they give us all the information that we know. Net profit, that value, they have given us retained profits, cash at bank. They have given us inventory at 31st December. So I'm just going to concentrate on inventory. So remember, these are books at the end of 31st December 2020. So this must be my closing inventory, okay? Because they are calling it inventory as at 31st December 2020. This is my closing inventory. So mine is to proceed to see if I have my opening inventory. Let me proceed. So I don't seem to see my opening inventory. Let me go to the additional information and see what is there. So you see what they come here and say. Of course, they're saying the senior accountant of Kilunji Limited was on leave. The assistant accountant determined the net profit reflected in the trial balance, but had not taken into consideration the following things. Now, this is where the examiner wants to test you on inventory, IAS 2. So they say that the amount of inventory at 31st December, okay, of shillings 507,000 was used in determining the cost of sales, okay? Further information revealed that part of the inventory had a cost of 6.7. Okay, further information revealed that part of the inventory that had a cost of 6.7 had a net realizable value of 4.5 million. Had a net realizable value of 4.5 million. Now, what you'll be able to understand here is when you go up here, part of our inventory. Remember, we had inventory as 31st December. It is here. This 45,507 is what we have right here at the bottom. It's exactly what we have here. So the examiner wants now to test your understanding of, do you know that inventory is supposed to be valued at the lower of cost and net realizable value? And like they are telling you that these things had not been taken into consideration. So it means that there is an inventory of 6.7 that is sitting in what? That is sitting in your value of inventory that needs to be brought down to what? To the 4.5, because inventory should be valued at the lower of cost and the net realizable value, okay? So that is something that you needed to understand here. That if I'm going to do my maybe P&L or statement of financial position, because in the statement of financial position is also where we take the closing stock. Yours is to know that I should not take the whole 45,507 to record it, because I need to first reduce this inventory. So what I'll do, if I'm working on this question, what I'll basically do, I'll get this 45,507,000. First remove the 6.7 million, okay? Okay, I'll first remove the 6.7 million and then add the 4.5, okay? Add the 4.5. So that is what I may do. This less the 6.7 and add the 4.5. So basically what I'm trying to do is I'm removing the 6.7 because my inventory is no longer at 6.7, but it's rather 4.5. Alternatively, what somebody may do may just get the 6.7 and remove 4.5 to get the difference, and that difference they come and adjust it on the 45,507, and that is what they will definitely record within when they are determining their cost of sales, as well as when we come to the statement of financial position. That is the same amount that they will use when they are recording their current assets at the end of the year, okay? So I hope you get the principle why some of these things may seem to be very small or irrelevant, but at the end of the day, remember, because if you actually fail to find the right value of inventory here, it means that you're going to miss the mark in the statement of financial position. You're also going to get a wrong gross profit or cost of sales, okay? So you're going to get wrong marks. And that is why we are saying that inventory is a very key is a key component of the financial statements, okay? So that is the principle that you need to take. So you need to understand that every time I have a cost and an NRV, I should actually choose the lower, okay, when I'm valuing my inventory. So that is very key, and that is what basically I wanted to emphasize there, okay? Yeah. So So once I do that, now we are going to look at the aspect of FIFO and AVICO. Okay. Now, just so you know that when it comes to FIFO, when we are using this technique, it's basically we are saying that things that came in first are actually sold first. Like we are saying, first in, first out. Okay, first in, first out. So that is very good for us to understand. So we know that items that were bought maybe later are likely to be part of our closing stock compared to items that were bought at the start of the period. Okay, yeah. So that is what we basically do when we are using this technique. Now, AVICO. With AVICO, we basically saying that we can't separate either stock came in first or came in last. Okay, we actually go ahead to get what we call the average cost. Okay, and this usually happens because you sometimes buy inventory at different values. Okay, you sometimes buy inventory at different values. Today you've bought, let's say, inventory at let's say maybe 20,000, and the next time you go and the price has gone to 25. So yours is to ask yourself, so what will I value my inventory on? Okay, and sometimes you mix these things when you bring them to your premises. Okay, so you need to understand how to use both these two techniques. Okay, yeah, AVICO and FIFO. Okay, like you saw, one of the things that you get to realize that one of the things that the examiner is interested in, how to apply these two things. Okay, from just the question that we're trying to look at, I think that was it 2017? Okay, yeah, this was 2017. The one we shall just come back to guide you. As you can see, was this question? This was the question. Okay, so in the same way, the examiner will ask you still the two methods. Okay, so you just need to understand how to play with each of them. So they bring you different purchases, okay, different inventory information, and then they want to ask you what exactly happened. Okay, yeah. So now, as we can see here, they're just trying to highlight that IAS does not permit LIFO. Like I said, there's what we call last in, first out. I don't know if you might find this in any course unit, but just so you know. Okay, so we basically use AVICO and FIFO. Okay, so there's just a small example here that will help us know how to handle the other question. Okay, so we have transactions here that happened in May 2017. As you can see, we have May 2017. They're telling us that opening balance, this is like your opening stock. Okay, so we had 100 units valued at $2. The total cost is 200. And then we have receipts. Okay, so we have receipts at 400. Okay, the receipts are 400 units, costed at 2.10. So this value is 8.4 or 840. Now, here is now the dilemma. Okay, here is the dilemma. Why will I call it the dilemma? Because remember, you're going to now you issued on 4th May, you issued 200. So the whole dilemma is what stock are we going to issue? Because we have stock of different categories. We have stock at $2 and then we have stock at 2.10. So we have an issue of 200. Okay, now this is where the decision on LIFO and FIFO may come in. So as you can see, if at all, now this question goes ahead to ask us, how would issues and closing inventory be valued using each of the following in turn? Okay, so we even have another receipt that came in at 2.12, and actually when you get now to this inventory, this issue of 400, you now have even inventory of different categories. You have inventory at 2, you have inventory at 2.1, even have inventory at 2.12, and so on. Okay, so the whole inventory valuation is what value shall we attach? What will be the unit cost of these inventories that we're actually issuing? Okay, so that is the principle that we want to basically get when it comes to here. Okay, now when it comes to FIFO, okay, when it comes to FIFO, ours is to look at what inventory came in first and which inventory should now move out first. So for example, we started with 100 units valued at 2.0, and then we got receipts of 400, okay, valued at 2.10. So it means that when we are issuing at FIFO, it means that this 200 will first be, we shall first consider this 100 that we started with, okay? We shall first consider the 100 we started with, and then the next 100 will be considered off what? Off the 400, okay? So we are going to have this stock divided by 2. We shall first sell off what we started with, and then since we've finished all of it, the 100, because this is 200, so we shall finish the whole 100, and then the remaining 100 shall be picked from the next, okay? So that is the key principle when it comes to how we are going to value the issue. So we are going to see how that plays, okay? When it comes to here. Now, this is, you'll actually find this to be solved for you, okay? But just to show you what exactly we have. So I'll not use Excel to calculate this because of time. I just want to basically guide you. So like you've seen, when it comes to the to either FIFO or AVICO, it is actually on the time of issue, okay? So we are going to see how that was played up when it came to here. So you can see that on 4th May, okay? On 4th May, when we are actually issuing, you can see we first issued with what we started with, which was at $2, okay? And then the other next issue was for the next stock of 2.10. And that is what we are having as 200 and 400 to be valued at 410. So ideally, our inventory that was issued on this date of 4th May, when we are using FIFO, will now be 410. So if you want to record the cost, this will be 410. So I guess you're picking the principle, okay? So we are going to see how that plays when it comes to inventory at there is this issue at this level, okay? Now, if we issued on 4th May, we issued 200, it means that we no longer have this inventory. This inventory is now used up, okay? This is used up. Just a moment. I wanted to highlight this, okay? So this is used up. We no longer have this, okay? We no longer have this within our premises. Now, when it comes to the receipts on 3rd, we now only have 100 remaining because part of the, okay, we now have, we have 300 that is remaining here because we've already issued something when we are issuing at this level, okay? When we're issuing at this level, we picked 100 from here. So here we now have 300 remaining. So it means that if we get another receipt of let's say 300 at this level, and then we are issuing at this level, issuing on 11 May, when we are issuing on 11 May, we are going to first start from the 300 that remained here. So we shall have 300 valued at 2.10, and then the balance to make this 400 will actually come from this, okay? So we shall have 300 valued at 2.10, and then we shall have the rest, which is, since this is an issue of 400, so the next 100 will be at 2.12, okay? So that is exactly what they were trying to do here. So the 300 was at 2.10, and then it was only the 100 that was at this level, okay? So you need to take on and understand how that principle works, okay? And that is exactly what somebody wants to test when it comes to AVICO, when it comes to FIFO. The same principle you would use also when it comes to this issue on, I think we had another issue on 20th May. Now the issue on 20th May, remember, we've already issued this. This one no longer exists. This inventory no longer exists. Let me just click here. This inventory is no longer exists in our premises. This one. Okay, so this no longer exists. Don't know why it is. Okay, that one is no longer exists. Okay, because we've used all of it. So what we have, remember, we used only 100 of this. Okay, so we still have inventory on 9th May. We only used 100, so we still have 200. So it means that the issue, this issue we shall make, sorry. It means that the next issue that we are going to make on this date will definitely be valued at what? Will definitely be valued at part of the inventory that is remaining at this level. Okay, remember we've already issued 400. Part of the 400 issued 100, so there's still 100 here. So that inventory will be valued at 2.12. Okay, so when you come here, you'll be able to see something very similar here. So this 100 is now valued at what? At 2.12. The other inventory that is remaining. So as you can see, despite the fact that we issued on 20th May after we had bought this inventory, that was valued on 2.4, we didn't issue out this. We issued out starting from what we had remained with, and that's how the principle of AVICO works. Okay, that is how the principle of AVICO works. So I hope you're able to pick the message. Okay, now we just want to see how that be when it comes to AVICO. Now with AVICO, we do what we call the average cost. Okay, the word AVICO comes from the word average cost. So we basically get the average. Okay, and we call it basically the cumulative weighted average pricing method. Okay, now we are going to see how that plays. So we have our statement here. Now this information is also coming from what? Is coming from this summary they gave us at the start of the period. Okay, now this is what you need to note. If this is what you have as your inventory data, okay, on 1st May we had inventory valued at what? At 100. And then we have okay, inventory 100 units valued at 2.0, and the total cost is 200. The same thing also happens here. We have 400 valued at 2.10, and this gets us 840. Now I want you to see something small here. Now, instead of, if we are issuing inventory at this level, instead of us looking at what came in maybe first to issue at maybe at 2.0, ours is to first get our average cost, which we are calling it a weighted average cost. Now, when somebody says average cost, doesn't mean that we get 2.2 plus 2.10 and divide by 2. Okay, so we are going to see how we basically determine the cost that we are going to value this inventory. Okay, so watch and see exactly what is here. So I want us to first concentrate just on this inventory. So this is the principle. We started with 100, and this 100, its value is what? So its value is 200 because the unit price was 2. Now, on 3rd May, we received inventory that is coming to the premise, and this inventory was valued at, I think this was I think that was about 2.1. It was 2.1. So 2.1 times 400 gives us the 840. Okay, now, and actually the unit prices are right here. So the principle here is, as you can see, we have our total inventory, our total balance of inventory at this date, okay, is actually 500. Okay, the 100 that we started with and the 400 what we have bought. Now, For us to get the unit cost that we are going to value this 500 inventory at, what we are going to basically do is we are going to get this total value of inventory, okay, which is the 200 plus the 840, okay, and do what? And divide it by what we have as our inventory. Sorry. Now, our inventory is 5, the units are 500. So let's just do 104 divided by what? Divided by 500. Do you see what we get? We get 2.08, okay? 2.08, that is what we are able to get as our weighted average cost of this inventory, okay? Now, as some of you might want to do, like I said, you don't get, because they have called it weighted average, some students go on and miss this. They just want to get this 2 plus 2.10 and divide by 2 and think they are going to get the, now that is the average cost. But remember, here we are trying to look at the weighted average, okay? We are basically using the weighted average formula, okay? And that is why with weighted, we have to also look at the units as well. So that's why we had to first get this multiplied by 2 to determine the 200, and then 400 multiplied by 2.1 to get the 840. So once we get this total, the 1040 is what we divide by what? By the 500 to determine what? To determine our weighted value. So if we are issuing inventory on 4th May, it means that we are going to issue it at what rate? We are going to issue it at 2.08. So we are no longer looking at things of this came in first, this came in last. Ours is now to use the 2.08, okay? We are going to see, let's just see this with our question here, okay? So that we are able to get the principle even much better. I think the other side may want to confuse you, but I want you to observe something here. So they are telling us that Azan Limited is a wholesale distributor of wheat flour and recorded the following transactions during the month of January 2016, okay? So they're telling us that on 1st January, opening inventory was how much? Was 200 bags. And these were valued at 55,000 per bag, okay? They were valued at 55,000 per bag. Now, on 3rd January, he purchased 300 bags, valued at how much? Valued at 60,000, okay, per bag. Now, on 8th January, he sold 150 bags to who? To Ken Enterprises Limited. At how much? At 100,000 per bag, okay? At 100,000 per bag. Now, I want you to relate this to what we have the other side. Now, here, they have given you the selling price. Now, the selling price should not blind you, okay? At the end of the day, remember that they have, this question is also asking us to get a schedule that will help us to get the sales, the cost of sales, the gross profit, and so on, okay? So let's first close our eyes on this 100,000 because this is the sales figure, okay? Now, let's just first use the approach of FIFO, okay? Now, if we are using the approach of FIFO, I was to ask ourselves, what is this 150 bag? What is this, like, which of this inventory do we actually sell? Because remember, we started with 200 bags, we purchased 300 bags, and we now are selling 150 bags. Now, if we are using FIFO, it means that we actually sold, the bags that we sold are part of this inventory, okay? So it means that the bags we sold are actually valued at what? They are valued at 55,000. I hope you get the principle. The bags have the stock value or your cost of of these bags is at 55,000. And remember, you sold them at what? You sold them at 100,000. So you can be able to get your cost of sales, okay? Because the value of the bags, which is 150 times the 55 unit, okay? And then you're able to get the sales value, the selling price, or the sales revenue, which is 100 times 150. So the principle is for you to determine what was the actual cost of these bags that you sold on this date, okay? So if it is FIFO, it is direct. We are going to actually value these bags at 55 as our cost of these bags, okay? This is a selling price, okay? In the other example that we are looking at, we don't have definitely that selling price aspect. Now, I want us to do something when it comes to AVICO, okay? If at all we are using AVICO, what would we exactly have here, okay? I think, let me just open one of my Excels so we can be able to get the principle here when it comes to AVICO. So basically what we want to have when it comes to AVICO, let's just come here. So I want to just do a small schedule here that can give us a picture of what we are looking out for, okay? So we can have the date, okay? We can have date. Then we can have, of course, received and issued column, okay? We can have received, issued column. This issued can also be a sale, okay? This issued can also be basically the sale, okay? So let it not confuse you. Then we can also have, of course, the balance, okay? We can have the balance. And then we can also have now the valuation of inventory, which is value unit cost. This is inventory. We shall have, of course, what we have right there is our value unit costs. We can have our value unit, okay? And then what other column we have, okay? The unit cost, and then we can also have the price, okay? Can have the unit cost, and then we can have the price. I just want to demonstrate something for this that we have. So once we have that, let's first record ours. So we have, let's record the opening inventory, which is at 200 at 55,000, and this is at 1st January, okay? So 1st January, okay? So we have, in this case, it's actually a balance, okay? I think this is a balance that we are starting with, which is our opening balance. And they're telling us these are 200 bags. So let's record them. This is 200 bags. And as we can see, the 200 bags, they are telling us that these are valued at what? These 200 bags are valued at 50. Just confirm. They are valued at 55, okay? So the unit cost is 55. So it means that the overall value of this is actually 100. This is 11 million, okay? This is 11 million. So let's try to record the second transaction here. Second transaction. So the second transaction says that they purchased 300 bags. So they purchased 300 bags at 60,000, okay? So that's like a receipt. And that happened on no, the date is also key. This is 3rd January. Okay, so 3rd January, we actually received, okay, we received 300 bucks. Okay, and these 300 bucks, they are telling us that their value was 60,000. Okay, so you just come here, 60,000 in terms of value, 60,000 times the 300 is about 18 million. Okay, this is what we have. Okay, now we are now going to the issue. Okay, we are now going to the issue. Now, before we get to the issue, us is to determine what is the value, what is our closing balance here. Okay, so our closing balance at this date is what? Is 500 bucks. Okay, this is our closing balance. Now remember, I'm doing for AVICO. Okay, so this is our closing balance, which is 500. And what is the value? What is the total value of this inventory? It is actually 29. Okay, what is the unit cost? Now the unit cost that we are going to use here is this 29 divided by what? Divided by 500 to determine what? To give you 58,000. Okay, to give you your 58,000. So it means that on which date? Remember, we have an issue on the next date. That is, let's see, this was on 8th January. So on 8th January, we issued, which is our sale, 150 bucks at how much? At 100 per bag. Okay, so this is what we are going to basically do when we are trying to record this. This is 8th of January. Okay, it is an issue of how much? Of 100 bags. So we are issuing 100 bags. Okay, now remember the 100 bags, they didn't tell us the cost of the 100 bags, but they told us what? They told us that these bags were at 100,000. Okay, these bags were at 100,000. So what I may do also, I may actually, since the question asked me for sales revenue, I may even add sales revenue. Okay, column here. And what this means that my sales revenue, somebody has they are 150 bucks. So thank you. They're 150 bucks. 150 bucks. Okay. Yeah. So if there are 150 bucks, as we can see right there, ours is to actually the 100 bucks we have for the next. So it's 150 bucks at 100,000. So the sales revenue will be this times what? Times this. Okay. Now the value of this inventory will be what? Will be valued at a unit cost of how much? Of 58. Because 58 is our average, weighted average unit cost right here. So if I get this value of inventory, this is valued at 58. So it means that this inventory was worthy 8.7. Okay, this inventory was valued at 8.7. And like we said, this would definitely change if this was because this is this alone is this is AVICO. Okay, this is AVICO in itself. But if this was FIFO, what this means is that we shall have this, as we can see, this will be okay. When we come to 500, this 500 will not be even interested in this. If it's FIFO, will not be interested in getting this this value. Okay, all we shall come to issuing here. When we are issuing the value of this inventory, what we shall do is since this is 150 and we started with 200, this inventory will be valued at the 55, which is the value of inventory here. We shall basically value it at 55. Okay, so that is what we shall basically do. And even here, the unit cost will be 55. Sorry, I did something. So let me just try to correct this. This event will be 55 times 150 to give me 8.250. Okay, so that is what will happen, and that's how the two are distinguished. Okay, that's how you distinguish the two. So you proceed like that with the next of the question. As you saw, we had the next part of the question. Which next part? Just to see, the next part told us that they returned 100 bags which had been purchased on 3rd March. Okay, on 3rd March, because they were found of poor quality. So you can also record the return. Okay, and as you can see here, they have even specified which bags exactly. It was the bags that were bought on 3rd January, and from our perspective, we've not even sold them. Okay, so they still exist. Okay, so you can be able to go and adjust that. Then we also have a case of a purchase here. Then we're able to record. And then when we come to 19th January here, we have a sale of 70 bags. Now yours is to ask yourself, the last sale that we made was on what? Of 150, and it left us with 50 bags here. If we are looking at FIFO, that last sale left us with 50 bags here. So ours is to make sure we do what? Sell off the 50 that remained here, and then we come to what was purchased on January. Remember, part of what was purchased on January, 100 was returned, so there's 200 that was remaining. So we shall pick the remaining 20 from here. Okay, we shall pick that from there. So like that. So you're able to think through the question in an easier way, and that is how AVICO and FIFO works into play. Okay, when you go through, I would encourage you that after this class, just do a comprehensive study of what we have exactly in here. Okay, so you're able to know, because in the same way, as you can see, this was a very similar question. Okay, we have a very similar question like we are seeing right here. Okay, issued there. Okay, issues and receipts. Like I said, sometimes they can be called receipts. Another side can be called purchases. Okay, issues can also be called sales. Okay, and basically that is what the examiner wants to test when it comes to that perspective. Okay, yeah. Okay, somebody says, please throw more light on the returned inventory. Okay, just a moment, so I can see this. So you have questions and answers here that you'll actually find within this perspective. Okay, and this is just a summary to it. Let me just go back to the return on inventory here. So we have a perspective here where they're telling us that returned 100 bags which had been purchased on 3rd January. Okay, so what we can basically do when it comes to our column here, we can actually even add the return column. Okay, you can add the return column, right here. So if that is the case, let me just try to show you something here. Okay, let me use this app. So this is the perspective. So they are telling us that on the date of this was 12th January, 100 bags that were bought at this were returned. Okay, 12th of January. So this will be 12th of January. Okay, so $100 their returns. Okay, ours is to look at what is their value. Okay, now of course, as we have the returns of let's say 100, of course our balance after, because remember we our balance was 500 here. Okay, and then we had, okay, this, let me just go this a bit in a consistent way. So this was an issue of 150 bucks. Okay, when we issue 150 bucks, we actually remain with what? We remain with after that issue, we are going to remain, let me just even add a column here. So I record this balance right here and give it a value. So we have, we shall remain with 300, I think 50. Okay, that is what we shall remain with. And the value of what we shall remain with is still valued at what? Is still valued at 58. Okay, the unit cost. Because remember, we are looking at average. Okay, and if I'm to look at this, it is that. Okay, so if I issue goods on 12th January, or okay, if they are returns, these are returns which are 100, and they're telling us that these returns are being picked from what? From what was purchased on 3rd. So these returns basically, in terms of their unit cost, is what we basically do have in terms of what we bought them. Okay, remember they have given us the specific what? The specific stock, and we basically bought them at 60. We bought them at 60,000, I think so. Okay, so we are able to get 160,000 times this value. Okay, and then you're able to proceed like that. So on if you're to determine the balance, since we had 350, this will now come to 250. Okay, it will come to 250. Now, in terms of course, what we have remained with, remember, when you look at, we have inventory of 250 that we have remained with. So when it comes to, in terms of valuation, okay, in terms of valuation of what we have at hand, then we have to make sure that we get the difference. Okay, and then we are able to value it rightly. So when you get this is what we had remained with, and then we less this. Okay, and then we have okay, now when you divide, because it's average cost, when you divide 300,000 divided by 150, should be able to give you the average here, your average value. Okay, so something like this. And then when you look at the question here, they are saying that that was the return. Okay, and they have given us the specific goods that were returned. And then we have a purchase. We have what was purchased, so you're able to record this as well. Okay, so that should be the principle basically for you. But I encourage you to go through this material, because there are also some examples that you'll actually find in these notes that can really help you in that perspective. Okay, we cannot expound everything here, but at least I just felt I should give you some highlights, because the examiner can set anything, even what you may think that they may not set. Okay, so that's very important for us to know. Okay, yeah, so that is basically what I wanted to share with you today, and I hope it is helpful. Okay, one of the other things that I want you to look at, I want us to see if we can maybe look at it is the cash, I think cash flow statement, okay? Is the cash flow statement. Now, cash flow statements are not part of, they are basically not, you don't see them directly on our syllabus, okay? But they can actually be set, okay? They can be set. And I think the last time they were set, was it 2017 also? I don't know. I may need to check and see. Actually, I think it was set in 2017 in the same way, the same question. If not to, yeah, I don't know which year they were actually set, but they can also be set. This is actually, let me just try to check. Did I see them like in 2017? Yeah, but they can also be set. So take time to look through. This is, and I'm emphasizing this for my friends that are going to do the paper in the next few days. Make sure you read more about cash flow statements. Let me just try to check and see if you can even find some notes here. The examiner can surprise you with anything, okay? Let me just try to check here and see if you can find the cash flows. Yes, right here. So we have cash flow statements here. They're on page 387. I may not have a lot of time to go through this, but I want you to go through these just in case that if anything comes, you don't go astray, okay? And with cash flow statements, yours is to understand what goes under operating activities, what goes under investing activities, and then what goes under financing activities, which is the last, okay? And then also you also need to know the different formats, the direct method, the indirect method. Basically, once you have good understanding of the rest of the financial statements, you'll actually find this to be a bit friendly, okay? A bit friendly. Unless we really, because this is already, we already have a few days to the exam, so I wouldn't want really to disturb you with some of these things, but take a personal initiative and look through these notes. At least I shared them on both the WhatsApp groups. Just interest yourself and go through, because anything can happen. The examiner can just wake up and set you a paper where they expect that at least you've looked at some of these things, okay? So you don't want to reach, like we've seen in one of the papers we have looked at, like the examiner can actually set anything, okay? Can set anything to you. I know some people may say, but that one is not part of our course outline. Yes, it's not part of your course outline, but it doesn't cost the examiner anything to set it. Like I think we can see it here in the same paper of June 2017. They set the cash flow statement. Okay, so try to go through and see. Okay, we have a class on we have our last class. Our last class will be Sunday. Okay, our last class will be Sunday. So Sunday, maybe I can try to comment on it. I can give it about some 30 minutes, but I want you to read before we get there so that at least you have some knowledge on it. Okay, yeah. So we shall do that. But for the meantime, I just encourage you to continue reading and see how to not just go to the exam without tapping on anything. Yours is to get the syllabus as it is and search for any material that you're missing within those notes that I shared with you, okay? Yeah, I know we cannot easily cover everything, but at least I know you have more time on you and you can easily do some of these things. Okay. Yeah. So I want to basically leave you. It's just 1 minute to the close of the hour. So I want to leave you so you can concentrate on your other things. I only wanted to comment on inventory for this evening. Okay. And I hope that was helpful. So thanks so much and wish you all the best.